I just wanted to welcome everybody to the Market Update conference call. We have a handful of people on the phone, and I am Alex Weiss, one of the hosts here today with John Napolitano and Tom Fletcher. And I'll give the brief intro for our team, but I'll let John take the floor and introduce the main speaker today, Tom Fletcher. So, John, I'll let you take it from here.
Thank you, Mr. Alex. How are you? I vote for Led Zeppelin next time on the warm-up music. Anyway, wouldn't it be nice? Life would be boring if everything worked the way it's supposed to work all the time, meaning the last 2 or 3 years of investing, where every day everyone woke up expecting tomorrow to look better than the next day. We kind of all knew that Disney World, and we planned this call a while ago. And that's kind of good timing given the volatility that we've finally seen return to markets. And you might think that, gee, we're kind of calm when this stuff happens. And, it doesn't make us feel good, trust me. But we are kind of calm when this stuff happens, and that's because we know it's going to happen. And, that's why we spend time on things like allocations and trying to mitigate risk and trying to hit a target as opposed to just trying to shoot lights out and gunsling to be in numero uno every single year. So, and Fletch is kind of the master of that with his eyes on all things. But, that's how financial planning happens. The minutia of asset management, it's kind of technical. We'll talk something about that today in markets in general. But I want you to know that as it relates to the financial planning, we are rather calm because we're pretty confident that the plans we've set and the allocations we've designed are most likely and give us the highest probability of getting to point B, whatever your point B is. And for some of you, it's a moving target. I get it. So that's enough about me and how this all relates to financial planning. I'd like to turn it over to Tom Fletcher now, who kind of has the helm at the portfolio side of deciding who owns what inside the firm. Mr. Fletcher, good morning. Good afternoon.
How you doing there, John? Hi, Alex.
Good.
Thanks for the introduction. Doing well, thanks. So the purpose of my side of the call is actually just review what we've seen over the past year or so. We also wanted to provide our thoughts on looking forward on the economy, the Federal Reserve, and interest rates, the corporate earnings outlook, our outlook for stocks and bonds, and we wanted to spend quite a bit of time chatting what John just mentioned about the recent volatility we've had. Obviously, a lot has happened in the financial markets since Donald Trump won the election in 2016, which was a surprise. Prior to that election, the S&P 500 had already been up some 220% since March 2009. And if anyone had told you on that election night with Donald Trump elected president and the overnight futures down 500 points, that the U.S. markets would rally and be up over 25% over the next 15 months, I think it would be difficult to believe that was going to happen. So when you look back over that time period since the election, besides the results of the election itself, a lot of unnatural things have taken place in the market. It's not so much that the market increased by 25% during that time period, but instead it's the way it went up. For example, the market rose the full calendar year of 2017 without a single down month, which had never happened before. And by the end of January this year, the S&P 500 had risen 15 straight months without a down month, which was also unprecedented. And then up until February, the S&P had gone up 400 straight days without a 5% pullback. And as you guessed, that's also a record as well. And so once February came around, the market had the fastest retreat ever from a market high to what's known in investor lingo as a market correction, which means the market fell by at least 10%. In this case, it did fall by 10%, and that was over a 9-day period. So I think some questions we are all asking is what happened to create that volatility? The official catalyst for the volatility, if there is such a thing, was that in the monthly January employment report, which is published by the government, or the employment survey, it's another name for it, there was a snippet about an uptick in worker wages that raised inflation concerns. That report put pressure on bond prices, especially in the Treasury market, which spilled over into equity markets. And it might be a little confusing, but in the bond world, when bond prices go lower, yields go higher. And higher yields in Treasuries often equate to higher interest rates, or the perception of higher interest rates. And higher interest rates raise the potential concerns about slowing down economic growth or weighing down corporate profits. Also, those higher rates in theory can attract more buyers into bonds and introduce a potential competitor to stocks. So another catalyst for the volatility, which we feel was likely the main reason, was that investor sentiment had just become overly complacent, a sure thing, as John had mentioned earlier, or too frothy. Alan Greenspan several years ago coined the phrase irrational exuberance. He became famous for that. That's exactly what happened here, in our opinion. All those records I mentioned earlier are simply not normal for stock markets. 400 days without a 5% pullback, 15 straight months upward without a down month. Essentially, volatility became non-existent since the election. So I think it's a good time here to take a pause and discuss how markets have reacted historically to market corrections. As I mentioned earlier, the official definition of a correction is an approximate 10% drop in equity prices. You've heard me in meetings say ad nauseum that corrections often come without warning, and the downdrafts can be quite violent, as we recently witnessed. Often the reasons for corrections, though, are not necessarily clear, and I think that's partially the case here. It's important, though, to understand that as an investor, corrections have historically been a normal part of long-term investing. For example, if you look at the data since 1980, so 38 years, we've experienced 37 corrections in that span of time in the S&P 500, or that works out to an average about one per year. And during that 38-year period, the average correction was about 15.6% from peak to trough of the correction. And then looking further at that data from the last 36 corrections for the S&P 500, returns have actually been encouraging after a correction. 12 months after the last 36 corrections, data indicates markets gained back an average of 16% from their correction lows. So looking out 2 years after a correction, historical data indicates that results are even more encouraging, with the S&P gaining an average of 28% from their correction lows. Hence, our view is to invest for the long term, stay the course. We do think it's important to note, however, that recoveries from a correction are not necessarily linear. They tend to be uneven and choppy. In fact, we'd be surprised if we've seen the last of this particular correction, the volatility, and I think that's played out over the last week or two. Incidentally, the last correction that we had prior to the one we experienced this month was in late 2015 and early 2016, when markets were concerned about Chinese growth and the Fed beginning to raise interest rates. Since then, the markets have risen over 50% off its lows. So what's our outlook for stocks? Well, we're still constructive on equities despite the upside move we've seen since the election. There are a litany of encouraging indicators that point to positive fundamentals. Now, I've got a list here, and I apologize, we're going to go into the weeds a little bit, but to name a handful, the U.S. economy continues to grow, but doesn't appear to be overheating, which is important. Tax reform should be a boost for corporate America. Infrastructure spending should increase in some shape or form. The corporate earnings outlook is strong. Earnings are on track to grow double digits year over year from last year, and earnings tend to be the main driver of equity prices going forward. Valuations in equities, though elevated, they're not extreme by historical standards. The unemployment rate remains at historic lows. Exports are benefiting from a weaker U.S. dollar. The U.S. lending environment has improved, and also the risk of a recession, which is usually tough on stocks, remains pretty low at this juncture, at least as far as we can see. And I think it's important to note that we're not the only region enjoying the growth. 2017 was the first time in 10 years we've had synchronized growth across Europe, Asia, the U.S., and especially emerging markets, and earnings have reflected that. Now, you never know with markets, but considering the large upside move we've had in equity prices since the election, we would be surprised if equity markets had a similar year this year to last year's outsized moves. One obvious deterrent is what the markets are wrestling with right now, is coming to terms with a higher interest rate environment. Historically, and something to keep in mind here, is that historically midterm election years tend to add volatility to markets. And with all the political developments heating up in Washington these days, that volatility could increase, especially if the Russia investigation heats up. Two important factors that we're focusing on right now are inflation and interest rates. Inflation, though moving slightly higher, still remains historically low and is currently slightly below the Fed's 2% target. That may change at some juncture and likely will, but despite the recent jobs report, there are no indications that runaway inflation is in the cards, at least for the near future. And obviously, the Fed continues to raise interest rates at a slow and methodical, gradual pace. We think that they'll continue at that same pace going forward in the same manner. We think the last thing that the Fed wants to do is actually surprise the markets and spook the markets and potentially create instability, which could in turn dampen economic growth. It's important, though, to note here that the Fed is raising interest rates because they can. They see strong economic growth ahead and don't want the economy to overheat. Economic growth is generally good for stocks as long as inflation doesn't get out of hand. Now, despite all the headlines about rate rises and interest rate rises by the Fed, interest rates still remain at historic lows. Fed funds are currently only at 1.5%, 1.5%. So don't forget, they started with rates at essentially zero. So despite the large equity gains we've seen, one investment that actually hasn't been keeping pace is fixed income, and particularly treasuries, which have been trading lower on the stronger economic growth and concerns over the government spending deficit and interest rates hikes by the Fed. Some of you may be asking, why do we actually hold bonds? Well, there are actually a few reasons. One is to diversify our portfolios. Bonds can often provide uncorrelated results than equities can. In other words, if equities zig, bonds can actually zag, or they have that potential. Bonds provide liquidity and also provide income. And importantly, bonds also tend to smooth out portfolio volatility during times of market stress. For example, in 2017, we had very few down days, but when we did, bonds tended to outperform stocks. And bonds also generally outperformed equities during the recent sell-off we saw at the beginning of the month. Now, there are always risks to investing, and obviously, and unfortunately, we don't have a crystal ball. We do think it's important to identify at least a couple of factors that could derail this market. It's possible that the Fed could get behind the inflation curve and be required to raise interest rates more aggressively than they anticipated, which in turn could choke off an economic recovery or economic growth. There also could be an administrative policy error that could push us into recession, such as a trade war. For perspective, we are currently 105 months into an economic expansion, which is the second longest in history. The longest was 120 months, by the way. We are also in the second longest bull market in history. At some juncture, expansions and bull markets run out of real estate, and we have to be realistic and accept that. But despite what the pundits say, it's generally impossible to identify market tops and, for that matter, market bottoms. Again, we don't think a recession or a bear market is imminent, based on the indicators we watch, but we do think possibilities do exist. So to wrap up, in summary, looking at the recent pullback in prices, we think it was a normal and healthy correction, something that was overdue considering the lack of investor fear and the outsized move we'd seen in equity markets. We continue to believe economic fundamentals warrant long-term exposure to the market based on the current economic expansion, accelerating earnings growth. We have a business-friendly administration and Congress, and historically low inflation and interest rates. Looking forward, we'd expect more volatility this year than last. We'd expect returns this year to be less robust than last. And while our outlook for bonds is less rosy than equities, we feel that bonds are an important component of a diversified portfolio, especially if markets decline precipitously. Finally, we believe in long-term investing and agree that it would be counterproductive to try and time markets or make emotional trading decisions based on the market actions over the past month or so. So that's my 2 cents. And John, back to you.
Well, yeah,
Thank
actually,
you, Mr. Fletch.
oh, sorry,
Alex
John, after you.
Take it. Yeah, no, go ahead. I was going to say, Alex will wrap it up for us. If anyone has any questions, you know where to find Tom and I. And go ahead, Alex.
Yeah, so I just want to thank everyone for joining the call today. Any specific questions, feel free to reach out to myself, John, or Tom. My direct line, again, if you don't have it readily available, is 781-884-2356. And we just want to thank everyone. This will be recorded, so if you would like to listen to it, we will send it out in next week's newsletter. And as you know, that comes out every Wednesday, approximately about 5:30 p.m.